Welcome, Marco, to Wealth Matters podcast. I sincerely appreciate you taking time out of your busy schedule to be here.
It's my pleasure, Alpesh, to be here. I thank you for the invite. I hope I can provide your audience some great content and valuable information.
I'm pretty sure you will. Hey, so Marco, I'm assuming that most of the listeners would know about you, but I still want to ask, how did you get started in real estate investing, and what have you done to be successful?
Well, that's a big question. So I guess the short story is that I actually started investing when I turned 18 years old. I bought my first rental property, and I was able to qualify for financing. So that's why
That's
I had
nice.
to. Yeah, it's kind of funny when I say to people I had to wait until I was 18. But like your audience, they have W-2 paying jobs, right? They
Yes.
generate their income, with a well-paying job. It's W-2 income. I was fortunate enough to have a decent job back then that paid well. So I had enough saved for a down payment for a property. So I bought a property that needed a little bit of work. It needed some work. So I bought it, fixed it up. I put a sign on the lawn. There was no internet back then.
Right.
And took some lease applications and interviewed some people, leased it up and managed it. And I held that for a number of years. So it was a great rental. And that was how I got started. It was the right time. The big mistake I made, and I didn't know this was a mistake at the time, is I actually sold that property. And that sounds kind of crazy, but it's okay. It's okay to sell property if you're doing something with the equity and you're able to reinvest it so you can do better.
Yep.
But not knowing what I know today, I made the mistake of not doing a tax-deferred exchange and buying more rental property.
Oh, so you're talking about 1031 exchange.
Yeah. Well, even if you don't do a 1031 exchange, it would have been wise if I took that the equity and reinvested it.
Oh, yes.
So that was the mistake I made without knowing that it was, a big mistake. I probably felt in my gut that I shouldn't just take the equity and go and buy a car or whatever I did with it. But
Right.
at least I got started, at least I did something.
And at least you learned, right? So I wish I was 18 when I acquired my first property.
Yeah, well, that's the thing. I mean, experience is one of the best teachers. If you can take action, the fact that you are doing something, even if you fail at it, you're going to learn as you go, and you'll learn what works and what doesn't work.
Yeah,
So,
I tell my listeners that you pay for education one way or another, right? Either it's through experience, or either you go to someone, a mentor, and you pay for the education, right? So
yeah. Well, you're going to learn one way or another. You can learn through mentors and coaches, or you can, learn through experience, or a combination of both. And for me, initially it was through experience, no live coaching. But ultimately, as time went on, I started to learn more, read more, go to seminars, buy courses. And, I wanted to educate myself, which is important. It's my first rule of my 10 rules. And, that's something that I tell people all the time, is to invest in yourself. It's great to be an investor, but if you're not investing in yourself, you're probably not going to be a very good investor.
I couldn't agree more. And I keep telling my listeners, friends, family that keep investing in your education, right? So the past couple of years, of course, listening to people like you, I have been attending tons of conferences, taking video courses, meetups, wherever I can go, meet people, learn from them as much as possible. And it has been my goal that every day I have to learn something new. It could be something really minor. I don't care, but as long as I can learn something new every day, then my day is all worthwhile, right?
Oh yeah, absolutely. No, that's great. It's good that you recognize that. So the answer, to your first question is that was my start. I started early, and that was good. But then, in 2003, I got back into real estate investing, and then I really hit the ground running in 2004. Credit was easy to
Oh, yeah.
get. And that was that was dangerous as you know,
Yes.
for millions of people. It
For
was
a lot
very,
of people. Yep.
a lot of people got caught with their shorts down because they weren't investing, they were speculating, they were buying for
Yes.
appreciation. And we've seen this in California.
Yeah. I was going to say that, especially you and I are from California, and we have seen that people losing their shirts, right?
Yeah, well, that's the thing. I mean, if you're in the right place at the right time, you know, that's luck on your side, and you can get a lot of gains in equity. But the thing is, you could lose those gains, as many people did. If you don't know what to do with them, that makes you, you know, a poor or bad investor, just
Right.
purely out of ignorance. But with easy credit, you know, people were able to get a lot of properties, as I did as well. I bought a lot of property in a 9-month period in 2004. Most of it worked out fairly well, but you know, I still had, you know, my trouble properties. And
Of
the
course.
beautiful thing is from investing from Southern California and investing, you know, in markets like Florida, Georgia, Michigan. I was able to create systems and perfect those systems that I used for myself. And that is ultimately what turned into the business as it is today with Norada Real Estate, because the systems I was using for me to invest from far away, I'm now able to share with other people and use those same systems to allow them to do exactly what I did, or even better, actually.
That's
You know,
awesome.
there are more tools, more resources, and more information available today than when I started, you
Of
know,
course.
in 2003.
There is a lot, actually. That's how I've been learning. There is a lot available for
Yeah, we didn't even
anyone
have
to start.
podcasts back then.
Oh yeah, there was nothing, right? So for you, it's a hard, long journey, right? And you had to build all of these systems. But right now, most of it is available. Bigger pockets, tons of podcasts like your podcast, and it's just and networking events, right? So there's all kinds
Yeah.
of tools. So the title of this podcast is Creating Legacy Wealth from Real Estate, right? So what does legacy wealth mean for you?
Well, legacy wealth, in the simplest definition, means that you can pass it on. It goes beyond your life, your generation. Because if you have family or kids and you want to be able to pass that wealth along, you have the ability to do it. Not only do you create that wealth, but you have the ability to pass that wealth along in a tax deferred um, structure where your kids or your heirs can inherit that, and continue on, you know, preserving what you've built. You know, you've spent a lot of time and money building up a real estate portfolio of whatever that may be. So that generational wealth is important. But I don't want people to think that it's just about real estate, because you don't want to just give your kids your, you know,
Right.
your properties. And you know, if they're just inheriting that, you know, that's nice for them. But if they don't know how to manage money or to
No.
create that wealth or duplicate what you've done, they're going to, you know, piss it away, as they say. You know, they're
Right,
going to
right.
destroy it.
Exactly. If they haven't been through the process, if they don't know the systems, of course, it's not gonna work out at some point, right? Or either they're going to give it away without realizing the value of those real estate properties or assets.
Right. So when we talk about um, generational wealth, the wealth is not just measured in terms of dollars or
Nope.
assets. You should also measure generational wealth in terms of knowledge. You know, what
Yep.
family,
Education. Yep.
yeah, that family knowledge that you want to pass along, you need to teach your kids and your heirs what you know, and how, you know, how to properly manage, how to properly invest and manage cash flow, manage your assets, manage money, all that good stuff. You know, you got to pass all of it along, not just the assets.
Absolutely. So if we, I totally agree, right? Legacy wealth, generational wealth. So now let's say someone like me who has picked real estate as one of the, area where I want to become expert in, or at least, even if I'm not an expert, I want to make sure that I'm investing in right places, right type of properties. So what should one consider when searching for a market to invest? And I know because your website has properties from all over the US, and you have invested all over the US. So I'm pretty sure you follow certain processes or you have systems in place for this.
Yeah, so the first thing to understand is that the United States is made up of over 400 metro areas. In fact,
Absolutely.
if you include micro markets, there's well over 600.
Yep. And tertiary markets, primary, secondary, tertiary. Not many people know about this.
Right, right. So the fact that there are so many markets, you have to understand, or it should be pretty obvious to you that you have to be what I call being market agnostic. You're not married to any market. And the reason for that is because all real estate markets run for the most part independently of each other. So what I always like to say, what happens in the San Francisco Bay Area is different than what's happening in Houston, Texas, which will be different than what happens in Detroit, Michigan. And recognizing that local markets are exactly that. They're local. They have their own economies, their own supply and demand, their own pricing dynamics, their own inventories. So all these things come into play. And when you recognize that every market is unique, then you can say, well, hey, I've got investable capital. I've got savings that I worked hard for. Where am I going to invest that so it works the hardest for me, or where I get the best cash flow, or I get the best appreciation potential, or a combination of the two, which is something we loosely refer to as hybrid markets.
Yep.
And
like
so
the Texas markets, for example, are hybrid markets, right?
Yeah, they for the most part. I mean, a lot of them have kind of kicked into being strong growth markets over the recent years.
Yeah, Austin and Dallas definitely.
Dallas has gone crazy. It's kind of tapering off a little bit now, but Dallas has been since about 2014. It's been on a tear.
It's been on fire. Yeah.
So the point being is that it's important to understand that you should choose markets based on good fundamentals and good economics, markets that make sense, that have inventory, that you can cash flow well, and you have good growth potential. And of course, your team is important, having the right team on the ground. These are all things that we research and provide on a daily basis, but that doesn't mean you have to work with an organization like ours. You can do this on your own. You just have to learn what to look for and do the research. It's all due diligence. You can learn how to do this stuff. You just have to take action and make it happen.
Absolutely. So what are some of the tools or websites do you use or do you recommend to newbie investors, or even if it's that person is not newbie, like someone who is trying to scale up faster?
Well, there's a lot of free resources out there. A search engine like Google is a great tool because you can type in the name of a city followed by whatever the phrase is you're looking for, such as, job growth, population growth.
I use median house price as well. I just type Houston, Texas median house price. So that tells me when I'm trying to buy property that I want to stay around that range. So,
usually you'll find articles written on the subject, which gives you the information you're looking for.
Yes.
But as far as specific websites or tools, there's some free ones out there. There's some paid ones out there, like Zillow, Trulia are examples of free websites. Citydata.com is another website.
I recommend that one all the time. Yep.
So those are examples of free versions. There are websites, for example, Neighborhood Scout, which is a subscription model. That's not free. You have to pay for the neighborhood-based information. Like city level, there's some free information, but if you really want to get into the nitty-gritty and have a deep understanding of the market and the neighborhoods that these properties are in that you're looking at, that's a great tool. So I forgot the name of the other one. There was another one, and it just slipped my mind.
Rentometer is another one I use to look at the rents, right, in the market.
Yeah, that's one. From a rental perspective, there's another one called RentFacts.
Oh, yes.
So there's another one like that. They're pretty good. They're not 100% accurate, and they even have differences amongst the two. So it's even sometimes they will contradict. The best source for information on the rental market, I mean, those are great starting points, but always cross-reference those with the local property manager that you're working
Yes.
with, because sometimes the property will rent for more. Your property will rent for more than what those websites tell
That's
you.
that's a great advice. You can't beat local knowledge.
Right. So a manager that's already managing properties in that neighborhood or that area is going to know, what a 1,200 square foot 3-bedroom house is going to rent for. That's on a large lot on a private street. They're going to know.
Right. Totally agree. That's some of those are some of the tools I use, and thank you for sharing those tools. So I want to jump on to how can someone be a successful investor? What do they have to work on from mindset perspective, right? So what have you done to work on mindset, personal development? How can those contribute to your financial success?
Well, if you're asking me about mindset, it's critically important because in the beginning, I've already said that it's important that you invest in yourself first before you start investing in anything, whether it's the stock market, gold, silver, real
Right.
estate, whatever it may be. The smarter you are, in other words, let me put that in another way. The less ignorant you are, the more successful you will be.
Yeah.
Uh, Education, especially financial education, will take you from being average to good and from good to great. And that's really where you want to be. So you can assemble the right team, ask the right questions, understand what they're saying, and be able to make smart decisions. And it also allows you to do your due diligence when you're looking at any kind of investment, whether it's a business or it's a real estate investment. So education is critically important. This is why it's my first rule for successful real estate investing. But mindset is not just the financial education, it's also your level of confidence, your ability to manage your fear, uh, reading books like Think and Grow Rich,
Oh,
The
great book.
Seven Habits of Highly Successful People, How to Win Friends and Influence People. These are all great books to help you build the right kind of mindset. And listening to even some of the greats like Tony Robbins, Jim Rohn,
Jim Rohn, John Maxwell.
yeah, like listening to these people who are very understanding. I mean, they're successful, but they understand human psychology and
Yep,
what makes your brain tick.
that's the
So
key.
yeah, it's the better you understand yourself, the better the easier you'll find it to learn what you need to learn, and the more confident you're going to be. And the more you learn, the higher your level of confidence goes. So all of a sudden, you start to become almost unstoppable. You get to a point where your education and your knowledge and your confidence are so high that you can't help but to become successful.
You hit the nail on the head. I just finished reading The Compounding Effect by Brian Tracy.
Oh
Eh,
yeah,
Yeah, it's an awesome book, and I'm currently reading The Atomic Habits by James Clear. It's again
good.
pretty much extension of that book by Brian Tracy, and as you said, the mindset, the can-do attitude, and the willingness to learn. Right, that those all qualities go a long way.
Yeah, and you know what? If you have a hard time reading, if reading is not your thing, there's still no excuse because you
Yep.
can listen to podcasts like your podcast or my podcast, and you can listen to audiobooks.
Audibles. Yep.
So
That's a
there is no
great
excuse.
advice. Yeah, there is no excuse. You have so much available at your fingertips, right?
Yeah, yeah, especially today. I mean, audiobooks didn't exist 15 years ago. I don't think. I mean,
No?
we had like CDs and maybe cassette tapes at some point in time, but podcasting didn't even exist at
No.
that time.
And Kindle books, right? So I carry my phone, and I usually have about 40, 50 books on my phone. So
Yeah,
I
so
I,
there's no
I love
excuse.
reading, right? Exactly. So there is no excuse.
That's right.
So you kept mentioning the rules of real estate investments. Can you elaborate on those, the 10 rules of investments?
Yeah, do you just want me to just quickly highlight them?
Yes, please, if you can summarize them.
Sure. Yeah. So normally when I go through the 10 rules, it's like a 30-minute conversation just
Yes.
alone. But I'll just give you I'll just touch on each one. So the first one we've already talked about, and that's just to educate yourself for obvious reasons. That knowledge will take you from being a good investor to a great investor. The second is something that I'm sure many have heard before, but that really is to set investment goals and write them down. Be specific and clear, write them down, turn that into an action plan, and set yourself an investment criteria, because you're going to follow that criteria and it makes investing easier.
Easier, yeah.
The third is, what a lot of people, particularly in states like California, did, many years ago when credit was easy, and that's speculating. And so my rule is essentially never speculate. You want to have a long-term perspective in mind. Don't be chasing after appreciation, especially in a heated market. Invest prudently, buy properties that make sense the day you buy them, but don't be a speculator chasing after appreciation.
Great minds think alike. Everyone keeps asking me, why don't you invest in San Francisco Bay Area? And I said, no, I don't have any investments. And my primary residence is not an investment. So I don't own anything in Cali.
Well, anybody listening,
Purpose.
anybody listening to this that lives where you live, like in the Bay Area or any expensive market, whether it's New York, New Jersey,
Yeah.
Washington, D.C., Southern California, like these markets where property values are very high. And when I say very high, I'm talking from $400,000 to $4 million for, like a nice single family home. Those just don't cash flow well, and if at all, and they don't produce a good rate of return. Even if you bought those all cash, in other words, no financing, which is arguably a mistake.
Yep.
But if you purchase those properties all cash and you had cash flow, your rate of return is so small that you're probably losing against inflation from a cash flow perspective.
Yeah, even if you are breaking even, I don't think even you will break even, but most of the time you'll have negative cash flow. But as you said, even if you do have positive cash flow, you are losing against inflation.
Right. So you don't want to speculate. It's a big country. There's a lot of markets. There are a lot of opportunities out there. We see them every day. We post many of them, not all of them, on our website. So I can tell you that you don't have to think or make the mistake that to invest, you have to invest in your backyard, meaning, within an hour or two of where you live. If you can find the right deals and they make sense, then go for it. But if not, you have to start looking elsewhere. And so that segues to the fourth, and that's invest for cash flow, because unless it's generating positive cash flow and generating a real cash on cash return for you that's directly related to the income on that property, then I don't consider that an investment. So I like to call cash flow the glue that keeps your investment together, because if it's got positive cash flow, you're making money today and you're gaining equity over time. So you're actually winning on both ends. Fifth, we've talked about this, and that's just be market agnostic. We've already talked about the U.S. having over 400 metropolitan areas, and so choose the markets that make the most sense for you from an investment perspective. The sixth one is to take a top-down approach, which means that you're not looking at the property from the get-go. You're looking at the market, then the sub-market, then the neighborhood, and then the property, and then, of course, assembling a team to help you succeed. So you taking a top-down approach means that you're investing by focusing on the market and the local economy first, and then working your way down to the best neighborhoods, and then finally you look at the best deals within those neighborhoods. Number 7 would be diversification. Diversify across markets. And I'm talking about geographic diversification here. So what I like to say is you build a portfolio of 3 to 5 income properties in one market. And then when you have that footprint there, then you start building the same thing, 3 to 5 properties in another market, and then move on to the third market. You don't need more than 5 markets. 3 to 5 is the good range that you should focus on. And then you build 3 to 5, maybe 10 properties in each of those markets, and that's a great portfolio.
I totally agree.
So that's the whole thing about diversification. Number 8 is true for most people, and that is use professional property management. I don't think most people should self-manage. In fact, it's very hard to do.
Yeah,
But
it's very hard. I've learned it hard way.
yeah,
Even
I mean,
locally.
if you're local, that's one thing. It's doable if you understand how to deal with people and the tenant landlord laws and marketing skills and people skills, and you want to be the one taking the phone calls if there's any questions, complaints, or reasons for late payment. But 99% of the time, I think most people should use a full service professional property management company that really handles everything for you. It's a small cost of doing business, but it's well worth it, especially if you have a large portfolio. Number 9 is to maintain control. The thing I like about single family homes, duplexes, and fourplexes is you can buy these properties, hold them in your entity, be a direct investor, and you have complete control. You're not at the whim of corporations or fund managers through funds and partnerships, because at the end of the day, when you're investing in a fund, it's a paper-based asset. It's a paper-based investment. Sure, if you know the principles and you trust them, great. That might be a good deal. But sometimes, you're dealing with dishonest or unscrupulous people, and you don't want to be in a situation where you don't really have direct ownership within an asset. So I prefer being a direct investor, owning the portfolio, controlling the portfolio, rather than being involved in any kind of paper-based asset. And then last but not least, this is one of the powerful things about investment real estate is the fact that you can leverage your investment capital. And so I recommend more often than not that people borrow other people's money, in the form of mortgage financing to control 100% of the property, but really only put down 20%.
Yeah.
It just magnifies your returns and it accelerates your wealth creation.
Yeah. And leverage is how you scale up faster.
Yeah. Yeah. It allows you to scale much quicker, like to the tune of 4 to 1 or 5 to 1.
Yeah. Couldn't
So
agree more.
yeah. So
Thank you
those are
so
the
much.
10 rules.
Thank you so much for sharing those 10 rules. I think this summary was great. So how can people learn more about you, Marco?
Yeah, well, that's pretty easy. We have 2 websites that you could visit. Where we put all the properties is noradarealestate.com, Norada, noradarealestate.com. And then the other website is the home of our podcast, and it's the sister website, and that's simply passiverealestateinvesting.com, passiverealestateinvesting.com. So that's the same name as the podcast.
That's great. I'll put those websites as well in the show notes. Thanks again, Marco.
Well, it's been my pleasure. I greatly appreciate the invite, and I hope this has been helpful for your audience.
This was very helpful. I thoroughly enjoyed. Thanks again.
Thanks, Alpesh.